The US capital markets present several challenges and opportunities as the economy continues to show a positive outlook, with real GDP rising at an annualized rate of 6.4% in the first quarter of 2021. During post-Federal Open Market Committee rate-setting meeting press conference on April 28, 2021, Fed Chair Powell reiterated that the view of inflation was likely to be transitory and the Fed will remain accommodative until the labor market completely heals. While relative valuations have been favorable to US equities, even the diversified mix of growth and value fixed income portfolios seem to attract shorter duration exposure with a focus on credit relative to government bonds. On the other hand, many financial institutions and tech firms are implementing systems that will play a major role in managing economic data and financial market performance in post-pandemic economy. The distributed ledger technology and its capabilities have gradually moved from margins to the mainstream adoption. Most of the world's central banks have announced research programs on central bank digital currencies, CBDCs, and a few smaller countries have launched live CBDCs. In many ways, it appears that the distributed ledger technology of blockchain, DLT, the most common architecture, will continue to disrupt and challenge the inefficiencies arising with legacy technologies and operations. The FENG, the Financial Executives Networking Group, will bring together experts in the capital markets to explore the dynamics of how they will shape the future of capital markets in the age of the post-pandemic economy. And so for those of you who are new to the FENG is the Financial Executives Networking Group. It's the largest organization of its kind of executive finance professionals, approximately 40,000 members. I'd like to introduce my panel. We have Amy Lumiere.
Hi, how are you?
Maury Davis.
Good afternoon, everyone.
Jeff Bernstein.
Hi, thanks for having me.
And Vince Molinari. You're on mute, Vince, but.
Oh, you didn't have to hold up. I'm sorry. I was just saying greetings and thank you. But
Perfect. Super. So, Amy, if you could kindly tell the audience a little bit about your background, and then we'll go into some brief Q&A with you.
Sure. So I've been in corporate finance for around 21 years. And as far as foreign exchange, I began that career with American Express. And then I moved on to a boutique foreign exchange firm. American Express was great. It's just that they had not a plethora of products. So then I moved on to a boutique FX firm, and now I actually have my own company. I'm a broker for foreign exchange. I broker 99.9% of my deals through currency transfer. I have other partners that I work with, but it seems like in every case, currency transfer is just the best fit. So that's where I'm at right now. And
Perfect. Excellent. So Amy, let's start with coronavirus and how you think it will affect us, or how it's affected the exchange rates.
Sure. So uncertainty from a pandemic, usually increases volatility in currency markets. Generally, safe haven currencies like the USD, Swiss franc, and yen will move more bullish, and commodity currencies like the New Zealand, Australian, and Canadian dollar and ZAR exchange rates will pretty much fail. But it's so strange because currently the opposite is happening, whereas the USD is failing and actually supporting commodity currencies, along with other factors too.
Interesting. Thank you. So will the People's Bank of China change its FX policy?
Well, if you've read anything about it in the news, all the reporters are writing about it and they're saying yes. So what's been happening is Chinese central banks have asked China to let the yuan appreciate, which is crazy, to offset rising costs of commodity imports. However, I think this could hurt China's exports, and I know China does too. And so there's absolutely no commitments by China to do this. Now, in recent days, the yuan has strengthened. It's been at its high level since 2018, but don't let that fool you. This is because of the weakening dollar. So it will be hard for the USDCNY to reach 6.21 by December, I think. But then again, let's not forget who's in control. It's the children who have the play dates, but it's the parents. It's not the parents. The parents are the ones that set them up. So that's my view.
Interesting. Do you care to dig a little deeper into that metaphor for us?
Yes, absolutely. Well, China is trying to rule the entire world, and but to me, they are acting like children, as they always have. So but that's their goal, is to take over. So yeah, I feel really passionate about that. If you guys want to discuss this with me offline, that would be great. But it's just yeah, all the currencies right now we're fighting for first place. It's a really crazy time, and it's just amazing that people are saying that China is actually going to increase the valuation of their currency, when we all know China. So don't think that's ever going to happen.
So what about the US dollar?
Well, the FOMC did say that they were going to ease buying bonds, but those tides have kind of turned lately. Now they're holding off for a while to keep interest rates low. And so this could cause the USD to lose value even more. We have a big dilemma in the US because we're seeing signs of inflation, and it's just spiking. So it's been hard. I don't know if any of you have ever tried to buy or hire a contractor lately, or buy lumber or any of that, but I mean, it's becoming a huge problem, not only in the US though, really all around the world.
Interesting. So this
Isn't that, Amy, is that more just because we're just really catching up from COVID, and supply chains were really drained, and obviously demand wasn't perhaps as slow as everybody thought, and so now we're really refilling all of those supply chains, which really is forcing forcing prices up, because everybody's been double and triple ordering commodities, and that flows through the whole system. So isn't that the real cause of the inflation?
100%, yes. We're coming back from coronavirus. The government is passing out all this money to everybody, just printing money. And everyone's getting stimulus, this, that, and the other. But on the other side, the manufacturers have had to quit manufacturing because there wasn't a demand. So now it's all hit in the last couple months. There's this huge demand, and the manufacturers just can't, they can't keep up. So and this is not just in the US, but this is worldwide. This is happening everywhere. Australia can't keep up. Their inflation is skyrocketing. China's is, and that's why they're trying to kind of pull this, the banks are trying to get China to do this, but I just don't think that's going to happen with China, because their exports are so huge. I mean, that's their main source of income. So.
Mark, you're on mute.
Yes, that's
Mark?
really true. So back to earlier, so this puts the US dollar at a bearish position with respect to the Canadian dollar, correct?
Again, we have basically, the same type of scenario. It's somewhat of a bloodbath with this pair of currencies, really for the USD, I mean, the USCAD is trending at a 2017 level again because of inflation. So there's a spending frenzy and people are buying up commodities. And as we all know, Canada is a commodities currency, oil, aluminum, etc. So yeah, the US dollar has devaluated against the CAD.
What's the current status of the euro?
So the euro rose against its major European rivals on Monday due to improving vaccine outlook and signs of Eurozone's recovery. But earlier this month, a lot of business activity also began to accelerate, and its fastest pace with new orders is coming in at a rate really that they've never seen in 15 years. So as a result, some think the European Central Bank will slow its emergency bond buying. And the US was going to do that. So the euro is looking pretty good right now.
Interesting. So, Amy, let's change course and talk about FX trading for a bit.
Okay, sure, yeah. I just, can I just add something? I just want to say that, at the bottom line, at the beginning of the inception of the coronavirus, it was a hard hit for the currency markets, but we've pretty much just arrived at the fairgrounds, I guess you could say, because I think it's going to be a long ride, and I don't think it's going to get any more mild. So buckle up your seatbelts, because the currency markets have just begun. Everyone's trying to duke it out, to not only survive, but to, have a currency that supersedes the rest. And right now it's just become a war, really. So I'm sorry, go ahead.
No, thank you for imparting your knowledge and wisdom. So let's change course and talk about FX trading for a bit.
Mm-hmm.
Do you have any trading strategies or tips, that you can implement that we may not know about, or that you execute slightly differently?
Okay. Well, I would say, other than usual hedging and options, etc., the one way I do differentiate myself is to manage my clients' larger, unexpected or last minute trades that they're not able to hedge because of the timing. So oftentimes companies need to send a larger payment at the last minute, meaning like the next 1 to 4 days. And so rather than just trading the entire amount on the spot market, and risking getting that rate, that unfavorable rate at the time, my clients, they'll give me a heads up that they need to trade, say, example, for 10 million CAD in 3 days. And so I then watch the market for them. And during those 3 days, I trade in tranches when rates are in their favor, along with placing orders, based on what's going on in the markets, around the world, interest rates, commodities, prices, coronavirus, politics, etc. So the goal is to get then the average rate for the period, as opposed to whatever the rate on that value date is. And this is something that banks tend to avoid because just of all the time it takes, involved in managing these trades. So I just want my clients to know that I will always go that extra mile for them and take the time to, because this managing trades has saved my clients hundreds of thousands of dollars, but it is very time consuming.
Sure. It's always good when someone really cares about their clients and invest that extra time. So that's excellent, Amy. Any tips that you could give finance executives when managing their own FX trades, since you've been doing this for such a long time?
Sure. So as you all know, finance executives wear a million hats, which can be extremely overwhelming. It's common to find an FX provider and just set it and forget it when it comes to FX rates and fees. This isn't a problem with commodities and securities because those markets are highly regulated, quite the opposite of the foreign exchange markets. So when we're talking about FX markets and their regulations, this consists primarily of mitigating fraud from the client side, like money laundering, et cetera. So, just try and be proactive in making sure that you're consistently receiving competitive FX rates. That would be my advice.
Okay, excellent. So, and what can you do to avoid this?
Like I said, just be proactive. Have a back rate analysis done at least twice a year. That's important just to check your rates. And most FX providers will do this free of charge. So, also it's a good idea to use a provider that reveals the real-time interbank rate. And this is really important alongside your client rate at the time you're booking the trade. Bloomberg does offer this for $25,000 a month per user, but we also offer this as well, but at no charge. So.
Okay, fantastic. Well, Amy, really want to thank you for investing your time with us. And like I said, just sharing those insights with us. Can you please share in the chat where people can find you, whether it's your LinkedIn or your website? And then also, folks in the audience, I want you to start thinking of questions you can ask Amy for the audience Q&A at the end. And also, please, this group is the Financial Executives Networking Group. Please share your contact information in the chat so that we can, meet and network with one another. So I'd like to introduce our next speaker, Maury Davis. Maury, if you can give the audience a little bit about your background. Thank you.
Sure. Pleasure to be with the group tonight. And Mark, thank you for organizing this. I think it's a fantastic panel and very pertinent. A number of different topics to discuss, and it's a great panel, and I'm glad to participate and be one of the panelists. I'm probably the youngest tenured panel member today. I've been in investment banking for the ripe old age of 7 years. I'm actually a converted energy and utility professional. Had worn a number of different hats within the energy and utilities sector, including corporate development, business development, finance, government relations, and operations, sales, and marketing. So moved to New York, and I have had the benefit of being part of a number of boutiques. I've never worked for a bulge bracket bank, but it's allowed me to develop my portfolio of clients and sort of my tool set, specifically starting with sort of energy and utility issues, and then moving into the broader scheme of infrastructure. I've had the benefit to work on a number of different transactions, from TMT to healthcare to obviously energy and utility sector elements, but then also brick and mortar opportunities as well, both here in the United States and then abroad. So my experience has been cross-border, and working with individuals now who are essentially across the globe, working on a variety of opportunities in a number of different fields. I would say right now my focus is more or less on the private markets as opposed to the capital markets, even though my tenure has been split between both. I just recently left an organization that was focusing exclusively on the public markets, and it was a very interesting year in that market, but now it seems to be some shift back into the private market. So I think my timing's been good, even though circumstances sort of led me into that position. But it's very interesting. A number of different factors on in the market. I'm sure we'll be talking about a lot. I know Jeff is going to talk a lot about things that are happening in the equity markets, and obviously Amy did a wonderful job talking about currencies and the exchange market, and Vince is going to talk a lot about the tech and the fintech side. But happy to talk about my background and some of the things I'm working on.
Perfect, excellent. So, Maury, just to clarify, you're not currently affiliated with a broker-dealer, is that correct?
Yes, that's correct.
Interesting. So how are you remaining busy in the capital markets in the absence of affiliation?
It's a good question. So a number of my engagements now are just purely advisory. I'm working with a number of corporations. I'm actually working with one organization that is considering a SPAC. I would say a little bit more than just considering it, but looking at doing something on that front here before the year is out. A number of private transactions. I'm actually helping an African aviation business expand into the U.S. It's already made a footprint in Europe, but it's looking to expand its stronghold into another market, and then also working on tech deals in the UK. So there's been a number of things that I've sort of worked on, privately and engaged directly with the corporations and the senior leadership team.
So tech in the UK, can you expound on that slightly? Sure.
Can't go into too much detail. It is a proprietary product, and they're not ready to roll it out, but it is essentially a startup. It's going to be a Series A raise, and it's going to deal specifically with some cutting edge technologies. They've done a pre-seed or seed round, if you want to call it that, which was almost entirely focused on technology development over the past 2 to 3 years. They have a prototype that I would say is post demonstration stage. They're really looking for a partner to help roll it out for them into a number of different markets globally. And so my role there would essentially be to help with that particular raise, and then probably some ancillary service outside of that on a follow-up, maybe subsequent ways, but we'll see. But essentially they have the ambition to eventually take this public within the next 5 to 7 years, and they have their plans pretty tight, and they just need someone to come in and firm it up and broker the right partnerships for them for their development.
Excellent. Given your energy and utility background, what are your observations in those sectors as it relates to capital requirements?
Yeah, that's an excellent question. I think the utility business is pretty much continued to hum pretty steadily throughout the entire disruption of this pandemic, and even now as we're kind of turning a corner on in the markets in terms of activity. If you look at debt capital raising from the utilities, I think it's remained pretty consistent, and in fact one can make the argument that that activity will probably, at least attractiveness to investors is probably going to increase here as we continue to experience some inflationary activity within the marketplace. So at least for the utility side, it's very interesting. On the energy side, I kind of go back to something that Amy said, given the commodities boom at the moment. You're seeing some activity and I guess some interest. I've looked at a couple of energy deals sort of tangentially, even though right now I'm not representing anyone in oil and gas. However, I will say that the anticipation from sort of the clean tech side has been very high, and I think that's in large part because of the wait and see nature of what's happening in the U.S. market. specifically for the federal government and defining what is infrastructure. And if that, if we get a sense that that's going to be a major part of this, which I think the clean tech sector is going to be a big focal point, then you're seeing a lot of money go into that, and actually you've seen a fair amount of private capital go into some of these deals right now. I was aware of a deal that was recently closed. The engagement, I guess, for the first tranche was 60 million for, a first time solar farm, essentially solar operation, and it has the potential for $100 million raise with incentives included. So that's not too shabby in this market, and I think you're just going to see more of that.
Yeah, actually, I'm on the advisory board with the American Association of Petroleum Geologists, UPitch, and we have a Shark Tank-like event. And so the clean tech, it's the big boys, Saudi Arabia, Saudi Aramco Ventures, Shell, BP, Sinopec. They've all been backing clean tech ventures, and then here in Houston, Greentown Labs, which is a huge startup facility. They've just moved down here. So the majors, people just don't know it, but the majors are definitely supporting and have been supporting clean tech. So excellent. So Maury, I know you've worked with several SPACs over the past year. The number of SPACs coming in the market in May have been light as compared to previous months. Is this a start of a sustained trend of reduced activity?
Yeah, that's a great question. I'm sure Jeff will have a perspective on that as well. But I think there's been a little bit of SPAC fatigue, even with the client that I'm advising right now. The good thing is they're in a vertical, in a sector that's fairly unique. So I think there's there'll be some interest, especially given what their business plan, their acquisition strategy is going to be. So overall, I think we're light as compared to the peak of last year, or you could say the turn at the end of last year. But there's some questions on the table. I know there's a lot of discussion on a federal level, kind of sorting out things as it relates to the SPAC market in general, and you may see some uptick from that once those issues start to become sorted out over time. So I would say just at this moment, it's the natural, when you've had so many SPACs come to market. I mean, it's been historic. It's natural for this kind of pullback, over the last couple of weeks in particular. But there's a potential for that to creep back up. So we'll see.
Interesting. Maury, with the steady drumbeat of IPOs steady to come over the market over the next several weeks, which sectors have offerings that interest you the most, and why?
You just look at the schedule. I think there's a lot of healthcare coming to market, and I'm sure we'll be talking a little bit more about that on this conference call. But it's very interesting to see that there's a lot of fintech money that's starting to move into the healthcare sector. That's going to be interesting to see. I think there's been good diversity. Obviously, sort of some of the pure tech plays have gotten a lot of activity over the last several months in terms of direct listings and things of that nature. But we'll definitely with these bigger healthcare opportunities that are being discussed. I mean, and anyone can go and see the calendar of what's being discussed there, but that should be interesting. Yep.
Okay, super. So, you've worked with a few minority broker dealers throughout your career. How have you seen that niche within the banking industry change over time, and where do you see it going moving forward?
Yeah. No, that's a great question. I would say I've worked for more minority broker dealers than I have for majority owned, or however you want to define them. But I have definitely seen over the past year that segment has grown significantly. in prominence, probably not in additional players, but definitely in deal flow, and definitely within the prominence of the banks within various deals. You're starting to see some of the, I would say, the big four minority banks, starting to lead more major transactions in the public markets. You're starting to see a little bit more activity on the private capital side as well. So, and the other thing is they're getting good publicity, good notoriety and recognition. I think the networks that are being built are very helpful. And then also, I think it's kind of related to just an overall consideration on just social issues in general, representation and diversity issues in general. I think people are more inclined to consider what kind of diversity banking they're including in a lot of these transactions.
Thank you, Maury. Well, ESG has become a very prominent issue in the capital markets over the past decade, and obviously in 2021, it's been huge. It's all over the news. How much more influence do you believe ESG programs could have on investors and also issuers?
Yeah, I mean, last year was a phenomenal year for ESG. I mean, if you just look, year over year, it's been quite a story. More and more firms are dealing specifically, have, larger coverage groups dealing specifically in ESG. One offering I would probably point to would be Google's offering from last summer, I believe, which was, over $5 billion, a five-part offering that went into the market. It was the largest ESG bond deal in the history of the program. So I think you're just going to see more of these, in particular, some of the more consumer-focused industries, as you would imagine, consumer discretionary. Names are probably going to include even more ESG projects and initiatives and things, and probably on the tech side as well. I think it's goodwill, and in a lot of cases there were earmarks for private capital going into ESG projects anyway. So public fundraising, public offerings related to ESG, I think is just going to be phenomenal. Is it going to be 2021 is going to be a larger year than 2020? Not exactly sure about that, but I think the trend line is certainly pointing to an incline on ESG activity.
Maury, with the current inflationary pressure we are all experiencing in the economy, what sectors do you believe have the best opportunity for investment at the moment?
Yeah, I think we've talked about some of them already. Utilities, I think, are going to be a staple. It usually is within an inflationary environment. Commodities, once again, I think is going to be a place that people are already turning to. There's going to be some real opportunities for individual investors to make money. Essentially coming out of sort of this tech boom and a very heated equity market. I think people are going to go back to some of these traditional sectors and really lay some bets down. So should be interesting.
Maury and Vince, I also want you to chime in on this as well, because I know that FinTech TV does a lot in emerging markets. So Maury, you have clients focused on the African diaspora. What evolutions have you seen in terms of market development on the African continent specifically?
That's a great question. I think it's one of the best kept secrets in the market right now. 6 of the fastest growing economies in the world are all on the continent of Africa. And, there's been a lot of coordination in terms of the African Union, a lot of business organizations. Obviously, I'm representing a client specifically in aviation. The influence or the interest in the aviation market there is tremendous, I will say, especially as they're talking about intracontinental flight routes and things, and then the potential for international freight coming out. There's been discussion on additional freight lines coming essentially straight out of Africa into Europe, South America, in order to essentially FOB destination in North America. So it's a very exciting time. I think what you're going to see is a lot more coordination by these private, sort of business forums and things of that nature that are, sort of leading a free market view on things. But, the governments are obviously smack dab in the middle of all these discussions. But I think, there's way more connectivity going on across the continent. Is very exciting to see.
And Vince, what are you seeing? And then Amy, if you could possibly chime in with regards to the FX markets on our African continent.
Well, I couldn't agree with Maury more. So on so many things, I could agree with Maury that he went through earlier. But I think when we look at the continent of Africa, massive opportunity that is largely under-recognized by many parts of the world, certainly in North America. When you look at nearly 25 years and younger, nearly 50% of the population. So tremendous youth engagement, the level of education, the amount of technology advancements that are being birthed and coded within the continent, and go north, south, east, west on the continent. The movement to capital market sophistication. You're beginning to see a lot more technology advancements generated from the continent and being exported. We're seeing that trend quite significantly being reversed. I see you're seeing a level of repatriation of skills, talents coming back to the continent, and developing and taking advantage of really what is moving from frontier marketplace to emerging marketplace. So largely educated expats coming back, bringing that education and technology know-how. So I think a force to be reckoned with and not to be underestimated in the global economy.
Excellent. Thanks for your point of view. And Amy, do you have some thoughts with regard to the FX markets in emerging markets?
Sure. Yes. Africa has made huge headway in the last, I would say at least 10 years with emerging markets. And yes, it's not just, imports, but it's a lot of exports too. Unfortunately, not quite yet has the US gotten on board like other countries around the world. I don't see a lot of African rand currencies being traded, but having said that, it definitely is making huge progress. And I just hope the US comes on board, like other countries have, sooner rather than later, because there's a wealth of opportunity in Africa. Absolutely.
Fantastic.
Hey, Mark, if you allow me, I just want to piggyback on
go ahead.
a couple of excellent things that both Amy and Vince said. Number one, from a currency standpoint, I can tell you right now, for my client, a lot of discussion has been around currency strategy related to some fundraising that they're doing. A lot of it is coming out of Europe, but then there is some American investor interest as well, and we're trying to structure that in a way that makes everyone comfortable. The one benefit for the client is, it's a heavy infrastructure transaction, so there's a lot of assets. But given the inflationary nature of doing business in most of these countries in general, it's going to be a consideration for anybody doing business there. But I agree with Amy. It's the U.S. is sort of behind the curve when it comes to Africa, and I know that President Obama had his doing business in Africa panel, which was pretty significant. But I don't, it's still kind of a snail's pace that we're, working to try to get a framework that U.S. investors are fully comfortable with as it relates to the continent in general as a whole. And to Vince's point, I just want to point out he's absolutely correct about the human capital there and the repatriation. In fact, the client that I'm dealing with, he grew up in Switzerland, but his parents are Ethiopian, so he's going back to Ethiopia and set up his business, and it's been phenomenal. He's created a entire corporation essentially of his countrymen by blood, and it's there's a lot of pride, a lot of civic pride related to that, and he's pretty close to the ministry there because of the nature of his work. The other thing I would just say is technologically, they have the benefit of not having any legacy infrastructure like the United States. So everything that's happening in Africa in terms of investments right now, you can classify almost as cutting edge, because they have the benefit of not having to unravel essentially a century's worth of older technology. They're coming to market with some of the best global offerings in terms of how to set up technological infrastructure and topography that you'll see anywhere. So it is very exciting time to be doing business in Africa right now, from my view.
Interesting. Yes. Thank you, everyone, for chiming in there. So, Maury, cryptocurrencies continue to grow in popularity, obviously, with several investor classes. Do you believe the recent declines in the market will delay their wider acceptance as a standard media exchange?
No, it's an excellent question. I hope I don't get myself in trouble on this call by sort of weighing in, but yeah, it is interesting to see the volatility in there. I'm sure Amy and Vince will probably have the entire panel will have a perspective on this, but I think the viability of these cryptocurrencies as a medium exchange is really about larger users validating and standardizing the use of these these currencies to actually transact. You've seen some very large corporations. I mean, I don't have to rehash that for anybody on this call, of people who are laying bets down on Bitcoin and a number of other currencies, and then names that are adjacent to the currencies. But I think over time, right now there's still a stigma or perception that most of this is very speculative. And I think the reason, part of the reason is just, the number of users. You can't go to your local grocery store and continue, to essentially do a regular transaction in Bitcoin, but people are looking at it as an asset class. I mean, there's a lot of money going into it. So, I think it's really going to get standardized once, larger places to essentially warehouse value are going to put a lot more value into cryptocurrencies. And then from there, I think you'll start to see that as being more widely accepted.
Interesting.
Well, if I may say something, the volatility of the cryptocurrencies is out of control.
Yeah.
That is, I mean, there's only, I've dealt with a couple for clients that is way safer than, say, Bitcoin. You can never count on any rate when you're booking a Bitcoin deal. I mean, it's just not going to happen. So I think that's the biggest problem in the industry right now. And so until that is corrected, I think that, you're going to lose money, you're going to make money, you're going to lose money. It's never going to be consistent.
Yep. I agree.
I think what the owners of these currencies need to decide in terms of how to market them as things, as they've got to decide, do they want these things to be currencies, in which case you kind of want to keep the volatility low, or do you want them to be actual stores of value, in which case then they can't really be currencies because you're betting on a continuously rising asset value. And so who would want to buy, pizza for something that's going to be worth 1,000 pizzas in 2 years? So, I still struggle with, you can't be both at the same time. You can't be both at the same time.
Great point.
Mark, could I just comment on
Please.
Yeah, so I think where we are is in this very clumsy stage of what Jeff is pointing out. What are we dealing with? And I think when you deal with, are we dealing with a currency, a store of value? Is this a utility token, right? So I think until we have greater clarity, as we've advocated for several years, of the intersection of this modernization of technology within our capital markets framework. So we have, whether it's SEC, CFTC, FINRA, and go out down the list, who may all have different views, including Treasury, of is this property in this instance? Is it a security here? Does it represent a commodity, or is it a currency? So until you define which, is Bitcoin actually much more akin to a currency, and ETH is more of a fuel to propel use cases. It's very clumsy. So it lends itself to quite a bit of speculation, and that creates obviously lots of turmoil depending upon what side of the trade you're on du jour.
Very interesting.
Yeah. I think the one thing that's very interesting within the market is, you look back even, 4 years, specifically at Bitcoin and some of these other, first of all, the number of offerings within cryptocurrencies, I mean, has gone up 10x. So there's a lot more of these to consider, and they all have sort of different criteria on how, what the value is based on and things of that nature. But the other thing is, in a lot of these cases, you're finding houses that are willing to lend against the value of these currencies, and I think that's very I wouldn't say concerning, but definitely something that you have to keep your eye on, because now the swings, to Amy's point, the swings are going to be even higher if people are sort of essentially lending against the value of these cryptocurrencies, and they're already fluctuating wildly. I think this is just going to exacerbate the issue even more. So,
and thank you all for the discussion. And Maury, current US housing data now suggests that demand in the market may be falling from its recent highs. Do you anticipate these latest numbers will impact the capital markets significantly? And if any of the other panelists have a response for that as well, I'd be interested to hear your point of view.
I think it is already. If you kind of look at some of the things that are happening right now and some of the reports that are being issued, I think the market's been very robust over the during the pandemic. I would say probably coming out of the midpoint, and it's been a very hot, robust market, and you're going to see some pullback on this as the market kind of settles out. But the housing market remains a barometer on economic health. I think that some people are starting to make some decisions, even off of the latest reports on new home sales and things of that nature. So it's a critical issue, and I think it remains a staple for evaluation within the capital markets in terms of the health of the economy.
Does anyone else have any thoughts on that? No? Okay, perfect. All right, well, Maury, if you can kindly share your LinkedIn information
Sure.
with the audience, and then everyone else as well. Kindly please share your website, your LinkedIn information. How can you add value to the other audience members, and also the speakers. If you're a member of the FANG, Matt Budd's philosophy of paying it forward and helping out your network. So with regards to the Financial Executives Networking Group. Okay, perfect, excellent. So once again, Maury Davis, thank you for your time. We really appreciate you.
My pleasure.
Introducing our next speaker, Mr. Jeff Bernstein with ICR Capital. Jeff, if you can briefly go into your background for our audience members. And audience members, I want you to start priming your questions as well, so that we can have some interesting dialogue once we finish with our last speaker, Vince Molinari. Thank you.
Hi, my name is Jeff Bernstein. I've been in the business for about 35 years, including 10 years at Goldman Sachs, where I was a managing director and responsible for the firm's technology, equities, business, distribution, capital markets, et cetera. I then spent 12 years as a hedge fund manager in New York City, managing long-short equity portfolios across all sectors, although with a focus on where technology was being disruptive and creating and destroying a lot of value in different sectors. For the last 10 years, probably, I have a family office or a multifamily office with a bunch of other ex-Goldman guys. And then for the last 4 years, I've been advising companies on their path to the public markets, and recently sold my company to ICR. And ICR is about a 23-year-old company, started out as an investor relations firm, primarily advising public companies on their IR path and managing their IR programs. And then they started a PR agency. Then increasingly we're being asked by private companies for advice around financial branding and branding to the investment community. And so they started a broker-dealer about 5 years ago. And so they bought my company, and we serve as an IPO advisor, as well as a SPAC advisor. So any entry path to the public markets, really. And we've probably advised at least half of all the SPACs that have come to market in the last year and a half. From an IPO perspective, in the last 6-7 weeks, we've advised companies like UiPath, Coursera, ACV Auctions, The Honest Company, and a company called Olo, a software company called Olo, as well as a couple others as they've tried to navigate these difficult capital markets, or I shouldn't say difficult, tired capital markets. So that's a bit about my background. And I think you're on mute, Monk.
There we go. There's my party trick once again. Superb. Excellent. Thank you for sharing your background with us, Jeff. We're honored to have you here. So, Jeff, can you give us a brief overview of ICR Capital and what role you play in the capital markets?
Sure. And maybe I'll just share a quick slide if people will indulge.
Perfect. Yes, please. Thank you.
Yeah. Hold on one second. Let me see if I can get my. So again, if can folks see that?
I can see it very clearly.
Yeah.
Yes.
So ICR, again, this is kind of the holistic view of ICR. Up and to the right there is kind of ICR Capital, which is our broker dealer. the firm really is populated by folks who are old like me, who have kind of had are in their second or third career. And so it's strictly an advisory role. We aren't underwriters. We're just a bunch of we're a bunch of people that, and we're about half female, half male, a bunch of people who just have done a lot in our careers and now are strictly advising boards, CEOs and CFOs on a very specific transaction, which is a public transaction, not only an IPO, but we've done direct listings and, as I said, SPACs, and then follow-ons. And it's all in connection with that. Our view is that these transactions are a branding event for your company, and therefore, efficient, tight communications need to be managed throughout the process with all the stakeholders, employees, investors, research analysts, the entire ecosystem, even your customers. And so we help in that positioning and messaging. And so my role primarily is on the capital market side. So if you, and I don't know how to do this because I'm not good at it. So these are some of the companies we've brought public, and we kind of say we have a differentiated approach. We talk to the equity capital markets groups at all of the banks. We talk to the bankers, obviously. We talk to investors every day. We talk to research analysts every day, and we talk to the media every day. And so we feel we have a unified approach to messaging, whatever a company wants to message, and position itself correctly. So as Maury was talking about before, about kind of fintech coming into healthcare, and fintech is, and Vince will talk about it later, but we're seeing some dramatic changes in what used to be fairly simple positioning for companies. Every company now wants to be known as a technology company. Now it's not just enough to be a technology company. Now, you're many companies want to be both a marketplace, an e-commerce player that has their own marketplace, but is also selling back-end software solutions and is doing payments. So when you have companies like Shopify or Stripe or Square that really are very complex companies and building incredible connectivity and stickiness in their markets, the positioning to investors becomes complex because, as everyone knows who's dealt with Wall Street, especially the equity markets at Wall Street, Wall Street's been very siloed. There are software analysts, there are financial services analysts, there are fintech analysts, there are internet analysts, and that's just in the technology group. And similar things on the buy side. If you go to Wellington or Fidelity or T. Rowe Price or any hedge fund, they tend to have analysts that are in depth. And so the capital markets are becoming a lot more complex, and we help the companies create a message that is going to get cast the widest berth and get them the highest multiple longer term. Here's kind of what we do. I'm not going to go through that. One of the most important things that has happened.
To go back, just so I think.
All right, I'll go back.
I'd be interested. I understand you think it might be boring, but
it's not boring. So what we do for companies, what we do for companies is, if you're going to go public, and let's say you're going to go public through an IPO, we will come in there about 6 months before you go out to select your banks to lead your offering. And so we will help you prepare with a full readiness review. Often we're working at that time with your auditors, obviously with your corporate counsel, and your CFO to, one, make sure that your audits you're going to be ready to file, because once you start that filing, you're as everybody knows, your auditors are under a lot of pressure to get all the PCAOB and all of the stuff done that you need to get done in order for the SEC to ultimately declare you effective. We start refining the story, so we will write what we call the box of an S1 or a prospectus for you that the banks will then refine. We'll help you develop a quarterly model that riffs off of your internal model, and then create a street-facing model, which will be more conservative, et cetera. So we do a lot of prep work on messaging, and then we help you decide on your bankers. So we'll bake off a whole bunch of banks. Baking off means you'll invite them to present what they think your story is over a couple-day period, including their views on valuation and positioning and how they would market the deal, et cetera. So we'll help you select those underwriters that will lead the transaction, and we will negotiate the economics for you of how much they're going to request that, these deals. Typically, for a $500 million IPO, you're talking very large fees, anywhere from 4 to 6%, probably. Actually, 5 or 6% of those gross proceeds will go to the banks. So we'll help you decide and build the right team with the right analysts. And again, I don't want to bore everyone. But if anyone is interested, I'm happy to go through it. And we host an analyst day, and we help all the analysts who are going to follow the company build their models and correct them, et cetera. And then we help the company decide who their shareholders should be. The books build for an IPO, and I can talk about this if everybody would like, but the books are building, and if it's a hot deal, every hedge fund in the world is coming in for stock, and they're big customers of Goldman Sachs or Morgan Stanley, and they want stock. But we're there because the banks have two customers. They have the issuer and all the funds. We're there to help the management allocate their stock the way they want to, rather than how the banks would like to. And so we feel we're really good at it. And if you look at the deals that we've advised on in the last 7 weeks, when the markets got tough, all of them are trading well above their final pricing. And not only that, in 4 out of the 6, we actually raised the range meaningfully. So we try to just give our best advice. One thing that I think is important with respect to the capital markets is, and I've been saying this to my clients, is that the public offering options have changed more in 2020 than they have in the last 40 years. When you look at the impact of COVID and what that did, and it's changed things forever. It's moved us. The trust mechanism used to be that you literally had to go and sit inside of Fidelity's offices as a management team, and they wouldn't allow any bankers in or so on and so forth, and you'd huddle with them, and there was a trust building session that took place kind of once or twice at most on a roadshow. The virtual roadshow has allowed companies, without a tremendous amount of expense and sweat, to meet investors multiple times, even before a process starts. And so by the time you go on your roadshow, you may have already met the folks at Fidelity and Wellington, et cetera, 3 times or more. So we do what's called testing the waters meetings. And so the discovery process has gotten a lot better, and the ability to know who's done the work to earn the right to get a large allocation on an IPO has increased a lot. And that gives us a lot of comfort. It's also expanded. The banks used to just take you to New York, Boston, Chicago, LA, San Francisco. And now virtual roadshows have opened up the access to these companies to great investors in many other cities, St. Louis, Dallas, wherever it is, because they're not just, it's not physical anymore. So that's one of the major things. The second big one is retail participation, which has really wreaked havoc on initial trading. The rise of obviously Robinhood and the other free trading apps has really allowed, especially when you're doing an offering of $100 million or $200 million, and those investors can't really access stock on an IPO, can only buy it in the aftermarket. They've become a force, and when they're present and they want to buy things, the stock can go. A bank would say, "Look, I really think you should. We really have great demand at $20 from the institutions, and that represents 22 times next year's EBITDA, which seems very sane with respect to the peer group." But then you'll see the stock open up 30%, 40, 50, 60. In a bull market, it wreaks havoc. And so price discovery makes it much more difficult. There's other things that are happening that I'm happy to go into. The banks are trying to build AI into their book building processes. Lockups, which used to be a standard 180 days where insiders couldn't sell stock, have changed dramatically. Some of it as a result of a bull market, others as a result of new innovations like direct listings, which allow insiders to sell a lot more stock on an initial trading day. And so the IPO markets are adjusting to these lockups and by and large getting acceptance from the public markets. Dual class stock, et cetera. And I'm droning on and on. So I'm gonna stop there and unshare my screen officially.
No worries. I think you gave us a great overview of how you work within the capital markets for those that weren't aware, and so you do a deep dive. Can you talk about the current state of the US equity capital markets given recent volatility in the markets, Jeff?
Yeah. As everyone here is aware, post everybody, IPOs basically stopped in March of 2020, and they really stopped for about 5 months. That backlog of companies that wanted to come public couldn't, and yet, as we also know, many, especially technology companies and healthcare companies, their business accelerated during the pandemic, and they accelerated for a lot of reasons. And so starting in September, there was a flood of new equity issuance, and by and large, they were tremendously successful, and the equity markets just kept gobbling them up. And anyone who's been a portfolio manager before knows what I'm talking about. Is if you're a portfolio manager of a tech portfolio or a small cap portfolio or a healthcare portfolio, you are really happy. You normally carry 60 positions, some 5%, some 2%. You carry 60 stocks in your portfolio, and suddenly all these cool companies are coming public, and you're going, wow, I need some of that. And so you see your portfolio start to balloon from 60 companies to 80, 85, et cetera. And you're doing well and you're putting up good numbers. Then all of a sudden something happens. And in this case, it was the specter of rising interest rates. And when you have the specter of rising interest rates, the value of growth equities starts to contract for obvious reasons. The second thing that was happening, obviously, as we ended COVID, was that people said, wait a second, where's earnings growth going to come from? Earnings growth is going to come from the refilling of the supply chain because commodities prices are going up and volumes are going to go up. And so the earnings growth is going to really be encyclical. So you had this double whammy that affected the IPO markets, which were primarily, as everybody knows, tech, healthcare, consumer goods. Those started to go out of favor. And so IPOs really started to get much, much harder to sell. And by and large, they continue to be harder to sell. Nothing. And secondly, the SPAC, which is another way of going public, also was ballooning out of control. Anyone who worked for 5 years at an investment bank or a company could raise $200 million in a SPAC and buy an electronic vehicle company. Yippee yay. And so that is now, thank God that's now ending. And we're going to get very rational. So we have this, this deflating new issues market, if you want to call it, which is a really good thing for the market. I suspect it's going to get better, probably September, October. I think most of the inflation is kind of this rebuilding of the supply chain inflation, and that's still going to take another 4 or 5 months. But as you know, the markets tend to anticipate the future. So by September, October, everybody's going to be looking out to Q1 and Q2 as they think about their portfolios and where they want to be positioned then. And so I suspect there'll be a rotation back into growth starting in September, October, maybe a little later. And then the IPO markets will kick in again.
So let's dive a little bit more into SPACs. Do you think I think you just said that they're going away, but
no, they're not going away. Not going away. They're going to be refined.
Refined. Okay. So you think they're here to stay, and how are they altering how companies think about going public?
So yeah, and so the reason I think they're going to be refined is because it is not a bad product. The reason it's a good product is that one, there can be some certainty. So as a private company, you can actually enter into a merger agreement with a SPAC to sell 25% of your company at X valuation, and they're bound to do that deal. And so in an IPO, you don't have any valuation certainty. You test the waters with the banks, come back and say, we think you're worth 7 times sales, 9 times sales. So in a SPAC merger agreement, you cut a deal, we're going public on 22 numbers of X, and this is the multiple. And so there's certainty there if you can close it. And closing the merger often entails first getting some private investors to come in on what's called a PIPE to validate that valuation. That's the part of the market that is done poorly lately, and I can go into why. But it does, and then you go public, and then you close the deal as a proxy vote, the shareholders vote, and you go public. So you get a certainty of valuation. That's what's good about the SPAC market, because an IPO is much riskier in that respect. Now you have to be a good company, and the SPAC and yourselves have to price the merger well, and that's what everybody's learning, and that's what's going to change about the markets. It's going to become a much more rational market. So I think it's going to remain, but I think it's going to become more rational. And the only people who are going to be able to do SPACs or raise a SPAC are, I think, what we call serial SPAC companies that have a good track record in choosing good companies to invest in and then bring public.
And then can you go into that a little bit more as well?
Sure.
Yeah.
So, and feel free, anybody else to come on in, but
yeah. Okay, I'm going to come on in. Sorry.
Nice.
Hi, this is Amy. I just wanted to I was trying to interject there between Mark and you, but yeah, I just have kind of a comment question. A lot of people, it's so hard to know what these SPACs are worth. How can you really know if it's a good investment because of all the different components that are involved?
One of the good things, actually, Amy, one of the interesting things about knowing whether it's a good investment or not is that the SPAC has to file publicly all the same things that a company going public would, and even more. So generally, they are not only filing what is similar to an S1, it's called an S4, that has tremendous amounts of information that investors can read, but they also will file their projections, which you are not doing in an IPO. And so the SPAC announces that they're going to merge with XYZ company, and they file they put a presentation out onto they file an 8K, which contains actual forward-looking projections. Now, the integrity of those projections is, hopefully the underwriters and the M&A advisors has done good work, and there's some integrity there. And I think there's some work to do on the SEC's part to make sure that some of these projections have integrity. But you actually have more information than you would normally have in an IPO. Secondly, you have the stock is trading. It's a liquid stock. And so, the SPAC announces a merger with XYZ company. As you know, everybody knows a SPAC normally is issued at $10. The SPAC enters into an agreement to buy 23% of the company, blah, 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 at a valuation of $1.3 billion. And you see the projections, and the stock starts trading at 12, 13. And then the company embarks on literally 4 months of meetings with institutional investors, as opposed to just an IPO roadshow. And this is partly why COVID has helped the IPO, but I can go into it. But literally the management team of the company, of the target company, is on the road, and you can buy or sell that stock whenever you want. And I actually think price discovery is easier with a SPAC than in an IPO.
And is that based on, yes, we can all see the financials, but is that based on the only differential I see is the projections? And to me, that's not really, something that I'm going to not, that I'm going to be able to sleep at night over. And forgive me if I'm ignorant. I'm just
no, you're totally not. It's definitely not ignorant. It's you on the good side. Chances are a couple things. One, you're going to have these projections. Two, that between the time that a SPAC is announced and the time the merger closes is generally around 4 months, and it's actually getting extended a little. So in that 4 months, that company is also going to report a quarter of earnings publicly. And so you're going to get to see that, which is a good thing. The bad part is, and where you really are going to have trouble, is by and large, the companies being chosen right now to merge into a SPAC are not ready for prime time. 90% of them have they're not public ready. They don't have an FP&A team that has been working on projections for 2 years. They may not have completed all of their audit work yet. It's TBD. There's a lot kind of on the come, and they're not public ready, and that's where it's kind of buyer beware. So that's where as a retail investor, you're just not going to have a clue, and unfortunately, and you can get a sense from it by watching the management presentation. But there aren't a lot of ways to do it. But that's why we like to try to work with seasoned SPAC management teams who choose wisely. And usually it's about choosing management.
Yeah, I just want to interject real quick. I think Jeff's 100% correct. And this has been my experience. It really comes down to the experience of the management team at the helm. It has a tremendous impact on investor confidence, especially when you're talking about the sponsor capital. I mean, and that's an entire, different conversation. But really, the value when you're looking at this is can these guys actually de-SPAC when it's time to execute? And really, what's telling is folks who have been there, who are organized, who are in tune with the process and can execute on that. And that's really what you're buying into. So I co-sign what Jeff's saying 100%.
Vince, have you, in the interviews that you've been having, what are your thoughts on that?
I take it from a little bit of a historic place where we're replacing some aspect of access to secondary liquidity for investors, right? We've historically, going back to the pre-Jobs Act, had 500 IPOs a year, right? whether it's Sarbanes-Oxley, order handling rules, Reg NMS, decimalization, we decline to about 100 IPOs a year. So the decrease in IPOs, we forget that that's our engine of capital formation, our job creation. So going to pre-Jobs Act creation, and we can talk about that later in 2010, we had this kind of confluence where the elongation period for venture capitalists went from 4 years to almost 10 years to a hold period. That dramatically changed the ROI. The exit strategy to private equity to IPO was greatly diminished. So I think what we're seeing here in the zest, and I fully agree with Jeff that SPACs are here to stay. They're going to be refined. They're going to be changed. They're going to adapt. What are they going to adapt to? To regulation, to being a bit more refined, to transparency. So I think what SPACs are doing are filling this gap of somewhat direct listing kind of equivalent, where there's lots of well-funded private entities that are looking more to the listing as secondary liquidity and access to exit for investors than needing tons and tons of capital. So I see it more as replacing some of the inventory that has diminished over the last decade in our public marketplaces. And what a great new product. I happen to think that from an issuer company standpoint, there is huge advantage to be able to talk about forward-looking statements in a SPAC versus what you can disclose in an IPO traditionally, dramatically different. So I think there's going to be some parity leveling of the playing field a little bit in disclosures and what comes forward.
Thank you for your insights and points of view. And so, Jeff, what other advice do you have for management teams?
I mean, the most important, to me, the most important thing for management teams is readiness. You know, great CFOs, that I've encountered throughout my career of private companies are meticulous in their planning. And I think it's really critical. I was on today with a friend of mine who I used to she was an analyst for my hedge fund, and she stopped doing that and actually did something smart for a living and went into the corporate world. And she helped take one very successful company called Alteryx public, and now has another company. And she's just incredibly organized in all of her work streams around readiness. So she has a timeline that she wants to go public by May of 23. In order to do that, there are 50 or 60 work streams just that a CFO has to accomplish in order to be ready from an audit perspective, from an internal construction FP&A perspective, compliance perspective, et cetera. And so I think the most important thing is planning. And that's, if people are interested, we have a whole, ourselves, we put out a readiness blur, thing that we have. If you have lawyers who regularly serve as corporate counsel for companies that are on track for a public offering, they have obviously regulatory readiness Gantt charts that they can give you. But readiness is the key, and really, and I think the second thing is being really true to yourself as your corporate culture. Don't try to be something that you're not. Be the best at what you are, and that kind of messaging really comes through, and investors can see BS coming. They may take advantage of your IPO, but they're not going to be around there forever if they don't sense that they can have an open and honest relationship with you. and that you are true to yourself.
Jeff, those were touching, actually, fantastic insights. So appreciate that. Thank you once again for joining us. If you can kindly share your information in the chat with the audience, so anyone who's interested in some further information from Jeff, please kindly reach out to him. And ladies and gentlemen, if you can also, if you haven't shared your information in the chat, this is the FANG Financial Executives Networking Group. We are here to, stimulate our own economies, so to speak. So please share your information and how can you add value to the rest of our members here. And so our last, but definitely not least, our final speaker is Vince Monolari with FinTech TV. And I will add, if you members of the audience haven't seen the show, or if you have interesting FinTech perspectives, you should definitely reach out to Vince. He's always looking for, obviously, he's the news for interesting speakers as well. So Vince, if you can kindly introduce yourself, and thank you for joining us, Jeff.
Well, thanks, Mark. I feel a little late saying thank you to you and Fang for the opportunity after been chatting in between here, but indeed, thank you. I'll try to be brief on some of the background and transition. I don't want to be the one standing between dinner and glasses of wine and some good Q&A. But yeah, it kind of an odd destination arrival for me, being a founder and CEO of a media company, considering I'm not sure I even took a comms class in college, but I think this may all be indicative of some of the digital transformation and the need for content. So real simply, I'm 30, Jeff, I'm sorry. I think, we're kindred spirits, 30 odd years, 35 years licensed in capital markets, financial services.
We're old.
Yeah, man. When we get to be the gray-haired one in the room, I'm in denial. But a couple of iterations, the last 25-ish probably as an entrepreneur, largely focused on emerging frontier markets, the intersection of technology. Before we were able to call it fintech, we didn't know that was fintech back then. And really trying to find, capture delta and find efficiencies with a technology solution. That evolved to probably much more engagement in private markets on registered securities 15 years ago versus publics, where I thought there were greater opportunities to compete as an entrepreneur, which led me to a really wonderful seat at the table pre the formation of the Jobs Act here in the US, which I tend to think of certainly some of the most meaningful changes to the 33 and 34 Act, that really was the advent of the removal of the ban on general solicitation, right? The ability to advertise a security for sale, changes in holder of record rules going from 500 to 2,000 before you were compelled to be a public reporting company, the changes in Reg A offerings and crowdfunding for securities and the test the water concepts coming through. So I was very fortunate to testify in front of Congress on those issues. I was one of the best bait and switch. The White House had asked that being an adult in the room around technology with lots of younger gangbusters to form an advocacy group, which we did. And it's only going to be a 6-month role during the rulemaking phase. 5 years later, we were still effectuating some of the lobbying on those rules. So that was a neat seat at the table. Continue to advocate, and I'll put up a couple of slides in a minute just for framing, but really our belief in the growth of the private marketplace as our job creator, our unregistered securities for some of the reasons that we talked about a couple of minutes ago, and really saw the growth of private securities really beginning to dwarf the issuance of our public securities in its aggregate, and the need for secondary liquidity in private markets. So built one of the early alternative trading systems for secondary liquidity of privates. I got blockchain fever probably in 2016, which was kind of late from a cryptography standpoint. This was a bit of the height of a lot of the ICOs, which I thought were in many instances wrought with fraud and misrepresentation. People pretending that they weren't securities either out of naivety or intentionality, as the case may be. So I wrote a petition to the SEC to deem digital assets to be securities under the Howey test in 2017, which 6 months later became part of the 21A report from the SEC deeming indeed digital assets to be securities. From there, I wrote 27 petitions for rule change comment letters to CFTC, FINRA, the SEC, 3 more sets of congressional testimony, and came out the other side of that with the first US registered broker-dealer to issue digital assets as securities and the first alternative trading system approved for secondary liquidity of digital assets. So lots of pain points in education, awareness, advocacy around digital transformation. I exited that broker-dealer in the fall of 2017, which was good timing. I had done some talks at the New York Stock Exchange around digitization and even basic things. Here's the difference between blockchain and Bitcoin, and my belief of blockchain being a permanent evolution in our capital markets. And I did a weekly show somewhere by accident, 10 million views later on YouTube. It became an accidental arrival of the top watched digital asset show in the world. After I sold the broker dealer, I was approached by a TV producer, said, "Hey, you should make this into a business." And I kind of had a good laugh out of it, but I had to sit on the beach period, and we birthed FinTech TV in December 2019 to really elevate and bring forward topics, demystify conversations around cryptocurrency, digital assets, fintech, and on the other hand, really an intersection that we believe strongly in is the show called The Impact, bringing forward everything on the Sustainable Development Goals, ESG integration, climate change. So we found ourselves 18 months later or so in 18 countries with 21 hosts, broadcasting out of 11 global stock exchanges around the world, and kind of this big need for content focused on education awareness on all of these new subjects. So somehow I get to kid myself in we know the media business, but it's been going well.
Superb. Thank you for that fantastic introduction. We're humbled and honored to have you on our panel. And so, Vince, what do you think is the impact of digital transformation on global capital markets? And if anyone else wants to, chime in, please do.
Look, I truly think that we're at the intersection of multiple paradigm shifts, and much of it being accelerated by COVID and this recognition and acceptance of digital transformation. So I do very strongly believe that when we look at the ability of transformation on blockchain, for example, digital representation of assets, their immutability, the what I think is so core, symmetry of information, particularly across marketplaces that have historically been quite the opposite. And in many instances, some people would advocate for that because there's delta or exploitation in certain cases when there's a lack of symmetry of information. So asymmetrical markets becoming more symmetrical given the advent of digitization and the ability to go cross-border, I think will create tremendous permanency in our capital markets, not only domestically, but globally.
Anyone want to add to that? Amy, Maury, Jeff?
I mean, I can't agree more. I mean, there's, especially just, we're so early in this, digitization stage. And, the last thing to get digitized is the thing that we exchange every day, which is money, and it ain't going to be easy. And you know, I've been both a critic and a champion my whole over the last 5 years of this, because as Vince said, there were so many charlatans and, you know, ICOs and all of these things that were being invented that really did the entire blockchain a disservice, in my mind. And you know, it's taking longer. You know, traditionally, really disruptive technologies, e-commerce, whatever it is, usually take about 6 or 7 years to prove out true real world proof of concept. This is taking longer, and it's taking longer partly because people are corrupting it in a lot of ways. And you know, and thankfully Vince is doing like the work to expose that and to also champion it, which I think is great, and I think is going to be really help institutions and individuals truly not get completely hosed. You know, when the U.S. government comes in and put, you know, because there's going to be a lot going on in the next 5 to 7 years. The governments have to grapple with all of this. How do we deal with our own digital currencies? And there's going to be a tremendous amount. You know, we when I ran my hedge fund, we always would say, you know, few winners, lots of losers. Any new technology, very few winners are created. Tons of losers are created in that first, missionary part of the and thanks to Vince and others who are hopefully going to keep exposing what is good about it and what should not exist.
Oh, thanks, Jeff.
And I'll just add the one, highly disruptive factor, the fact that this is going to collapse a lot of overhead as well. I think you're going to find a lot of transformation in the way a lot of these firms are going to look going forward, because quite honestly, for a lot of folks who decided that this wasn't the most pertinent issue for them at their stage in career, are probably going to find themselves becoming more of a niche operator, and in a lot of cases they'll probably go to their respective silo. But I think this is going to permeate through all phases of the capital markets business at some point, and it's going to really go to those who are savvy on this front and know how to integrate. And a lot of forward thinking firms and leaders are going to be the ones that are going to prosper on this. But even those coming into the market, you have no choice but to get up to speed on this. This has to be part of your skill set, and you have a pretty high learning curve on this. But the good thing is there's a lot of excitement around it. So I think people coming into the market are, bringing a lot of enthusiasm on that front as well. So it's very interesting. And then just real quick, the emerging market, I think there's a great opportunity there.
Amy, any thoughts on that question to Vince with regard to the impact of digital transformation on the FX and capital markets? You're on mute, ma'am. You're on mute, Miss Lumiere.
Sorry, I had it on mute.
Body trick.
Yes. Well, I have a client in China who's, needing to move a bunch of money into the US. So, we've come up with creative ways to do that thanks to the digital market. So I think it's going to be transformational. I do.
Excellent. So you're on board with that. That's wonderful. So Vince, what is the projection of private security issuance?
Oh yeah. I should jump to a slide in a second, but yeah. So I think if you look at try to look at our current day situation, look back at history to try to anticipate where the future is going to be. We traded Facebook. We created an alternative trading system when it was $2 billion in valuation and market cap, right? And what we start to see is that we realize that private securities can reach public company valuations as private enterprises. So looking at a move to $40–50 billion as a private enterprise. So that's set the stage for investors to now think about previously uncorrelated assets, right? Private securities relative to public, and achieve valuation expansion very akin to when something went public much earlier in the cycle. So that delta or alpha capture was much earlier. So that set the stage for private and unregistered securities, in my opinion, to be viewed differently as part of an asset allocation model. And I'm going to try this screen share. I was having a little problem with it earlier, but if I get it, there's a couple of things in here that I think are worth note. Oh, great. Here we go. I'm sorry. Bear with me 1 second. All right, this is not. Here we go. Sorry. And I'll just flip through this super quick. But this is, for many of us who have been around trading, I call it the evolution of an asset class and its tradability, right? We started with in-person trading. Then we went to voice brokerage, electronic trading, that electronic execution. And we look at that evolution to Bitcoin entry transactions. Now, if you put on the end of that where we started to go to high frequency trading algo, we're looking at levels of digitization compressing all of that, right? And if we look at digitization across private securities, you really start to see a difference. This is pre-Jobs Act. We were running about 1.2, 1.3 trillion dollars annually, 2010, in unregistered private securities issuance, about $1.5 trillion in our public markets. So our private markets certainly running second. As we got to 2015, you saw that private unregistered securities issuances began to creep up and surpass. Well, fast forward, and this stat's a little dated, but we're now at about 3.5 trillion annually of private unregistered security issuance, to about still about $1.5 trillion to maybe $1.8 trillion annually of our public markets. So we've seen such a greater inflow of capital to private unregistered securities, partially because of the type of security, the access to them, as well as the increased levels of secondary liquidity that's beginning to come in for private securities. So this last one I just tossed in because it's kind of reminiscent. We talk about technological advancements within our ecosystem. There's one that I like to point to quite a bit that gets not spoken about a lot. The paper crisis of the 70s, and people, I'd say the younger people and people younger than myself don't realize that there was physical stock certificates. They had runners that went back and forth to the exchanges and the back of the cages, right, for reconciliation. The American Stock Exchange shut down on Wednesdays to try to process the paper. Well, what happened? As we had increased trading, and you could see this from the 70s, 80s, 90s, and into the 2000s, the significant jumps in trading volumes on exchanges. Well, what happened? You couldn't process the paper. So we had the paper crisis of the 70s that put certain organizations out of business. But what it did, it fostered in the Depository Trust Corporation, the dematerialization, and the transfer agent. So we went to a electronic basis for stock ownership. Well, I view what we're seeing now as the next evolution of that when we look at the efficiency of a distributed ledger and the recognition of ownership in real time as the next evolution. So when we talk about what does it really mean? Well, in many instances, we haven't changed what a security is. No, not at all. We've changed a bit of the way we have access to it, the information, the recorded ownership, the immutability of it, but we haven't changed what a security is, what a securities contract is, what a piece of debt may represent. maybe, well, at least to me, smart contract kind of represents the ultimate structured product vehicle that could be debt, equity, revenue share, combination of those. So I guess it's a long answer with a little bit of a framework here to say that private securities issuances, particularly as we have retail engagement, has a big upward trajectory in our opinion.
Vince, thank you for your insights there. Will there be an increase in distribution and creation of impact?
Well, gosh, we have a show called The Impact. So the answer for us is absolutely yes. 11 years ago, I built the first US broker-dealer that was focused on for-profit instruments that were delivering societal, environmental, and cause-related good with the United Nations Global Compact and US State Department OPIC. And we crashed against the wall. It was a wonderful PR success, but the marketplace wasn't ready to think about for-profit instruments that could achieve societal good. It was the notion of it had to be philanthropic, or you had to compromise your real rate of return to do good. We have totally transcended that. I think what we're seeing now across the stack, the recognition of the United Nations Sustainable Development Goals, within that, how is capital moved to achieve the goals of 2030? I think you're seeing the advent of not only green bonds, blue bonds, investments that are focused on transformative agriculture, what you're seeing in regeneration, what you're seeing in renewable energy, all fitting in there, which are being investor demand bottom up oriented. And again, I think accelerated by COVID, as we've kind of had this holistic reset of values and what may be important, and this coexistence of how do we repair, benefit our planet while having a profit, and what are important to individuals' value systems. So again, yes, this is what I can go on for days, Mark, but I think when you look at the inclusion within our financial service system, and we could talk about that from boardrooms to gender equality, opportunity, where racism has infiltrated our capital market system, and how do we bring education and awareness? How do we create opportunity for wealth creation for entrepreneurs, not only of color, but try to minority women-owned business and the allocation of capital that they receive in the United States. We're talking about the low single digits. We are doing ourselves a disservice as a society by not empowering some of the greatest minds that we have, and what we leave on the table because we discriminate because of race, color, creed, and we are doing the planet a disservice. So I think there's a massive wake-up call, and I'm sorry, don't want to be on a soapbox about it, of how we truly engage as a society. I think it's no longer about, is impact investing part of capital markets? I think impact investing is going to save and redefine our capital markets.
Vince, thank you for your passion. Obviously, you actually truly do care about this. I was going to say something there, but I'm going to keep that to myself. Jeff, what are your thoughts, or what are you seeing with your clients with regard to impact?
Yeah, it's every, and I talked a bit about being authentic. There are some companies, some clients of ours, literally who at their core have been where ESG was at their core even before ESG was a thing, and across everything. For others, it's a check the box. And so if you're an impact investor, I think it's again, and I hate saying this because I feel like I've been saying it, we're early. We're still really early. At its heart, equity investors are investing to make money. for pension holders, whatever it is, endowments, whatever they're trying to get a total return. And so sometimes, look, impact investing or social, whatever you want to call it, can it stand in the way? Like, are you breaching a fiduciary duty by not maximizing your profit potential, by steering money in ways that to companies that are perhaps, and I don't know, and I'd love to learn more about it. But I can tell you from a corporate standpoint, it is becoming increasingly important that a company have environmental, social, and governance ethos that they carry through, and that is articulated in their filing documents. So you'll see now every S1 has an ESG section to it, and I think it's again, I just think it's going to be more about really not just it's really about owning the authenticity as a corporation. Whether you're in Allbirds, which I think is one of the great companies of the last 10 years, which is not only is transforming the way people think of footwear, but frankly is pushing the rest of the industry there. And I think, and rather than use it as a competitive weapon, they want to share how they access natural wools and things like that in a very sustainable way with the rest of the industry. And so, some companies are just going to be more authentic than others. And investors, I think, should choose those companies because, again, those are the companies that have the commitment and passion to be continuous winners.
That's a great point. Thank you very much. It's very interesting.
Can I add to that slightly, if that's okay, Mark?
Please.
Yeah, I think just to carry on Jeff's fine point, look, the authenticity, right? We are well past, and partly because of the transparency that's afforded through technology, that there's no more masquerading, right? And when you have things driven by shareholders, I think what we're seeing, the advent of shareholders that are consumers and consumers that are becoming stakeholders in organizations that they believe in and trust. So that is developing a high level of connectivity to the brand. They have to be authentic, and the morphing of the consumer and the stakeholder shareholder into one. So I think what you're really going to start to see is the valuations and the access of capital increasingly better and higher for those that are authentic and being rewarded by their stakeholders. And you're going to begin to see the opposite, impaired valuation, higher cost of capital to those who are not adhering.
Yeah, and that's a great point, Vince. And I think look, the rebellion against certain corporations in social media that are caught doing things that are clearly counter to what they pretend to be, and I think we've seen it recently with moving the All-Star game. I don't even remember what it is, but you can get called out now. And so it increases your burden as a corporation to be true to yourself, and shareholders are seeing it, are increasingly seeing it because of frankly social media, which calls it out.
Fantastic. Vince, is there a role for stable coins in capital markets?
Oh gosh, I'm sorry. I'm just texting my wife. Please hold my dinner. I'm still hungry. Sorry. Yes, stable coins. Again, no question. And and maybe I'll loop this in with CBDC, central bank digital currency. We talked about this for the last 2 years, that whether Treasury and the Fed were acknowledging that they're going to move to some level of a digital dollar. What was happening in China, what is happening in Europe, Caribbean countries, the development of central bank digital currency, and separately stable coins. When we look at the efficiency that is created in a settlement process of a represented value that is indeed underpinned with some substance to, we used to call, think about a continuous link settlement equivalent, right, in capital markets, right? The ability to settle globally with a stable coin is going to change the game on cross-border transactions. It's going to change the game in how perhaps the government could certainly deliver stimulus directly to people's wallets and phones in the not too distant future. What it's going to mean on a wholesale level and a resale level, I think, are quite significant. And I know we're bumping up against the hour. So I just, when we think about, I just pose one component here. If we look at, depending upon whose statistic you want to look at, 70 to 80% of global GDP is settled in a US dollar equivalent. What is going to happen when we have the advent of multiple global central bank digital currencies that are able to settle GDP? That is going to have a significant impact on the hierarchy and the strength of the US dollar. Therefore, there is not a doubt in my mind that Treasury and Fed are going to be compelled and accelerate the creation of a US digital dollar.
Excellent. And like I said, we do have a couple of minutes, so this will be our last question, just so that we can be prompt and end on time. I want to thank the FENG. I want to thank our speakers, Jeff, Maury, Amy, and Vince, and also the audience members. Vince, if you can share your information, and all the speakers, if you can kindly also just reshare your information in the chat. If you would like to ask them questions, please do reach out. This has been a very engaging discussion. And finally, Vince, will new data sets influence capital markets?
Oh, I got one more, huh?
Yes.
Absolutely. Look, we're moving, whether we realize it or not, from climate change to climate risk, right? We're moving from the marketing department down the hall of corporations and financial organizations. And Jeff talked about fiduciary responsibility. This is not the nice to do anymore from the marketing department. This is the fiduciary responsibility of the front office. This is your CFO, your treasurer. What risk mitigation is occurring in your organization? Please tell me about what your exposure to climate change is, whether that's wildfires that are occurring with regularity on the West Coast. What's the exposure to a municipal bond portfolio? What's the underwritten mortgage exposure in those territories that you didn't have to think about wildfires, droughts on crops, events that get canceled because of XYZ? So I think when you look at this phenomenon, you're really looking at the level of, now we have previously thought to be externalities that now can be measured. When you can measure and create analytics around clean structured data, you're going to change how instruments are traded and created. We're talking about ESG as being an alpha generator for the first time. If you're generating alpha from ESG, how are you going to capture that? What products are going to be structured around those instruments? And that comes from the new data sets. So.
Excellent, perfect. And it's 8 o'clock on the dot. Ladies and gentlemen, thank you for your time. Obviously, go ahead and enjoy your dinners if you hadn't already had them. Once again, I appreciate my speakers, Vince, Jeff, Maury, and Amy. This is the Financial Executives Networking Group. My name is Mark Hamzat Erebogbo. I'm the chairman of the Capital Markets Special Interest Group. We look forward to seeing you on our next edition. Thank you. Have a great evening, ladies and gentlemen.